So, hello everyone, welcome to this week's live session. As all of you know, second quiz of our course is scheduled on 16th of March, this Sunday, I think. And syllabus for this quiz will be content of week 5 to week 8, 4 weeks. Okay. And today we will be like going through some of the like the, I think almost all the topics which we covered in these 4 weeks, and we will do some examples. And if you have any doubts or questions, please let me know. You can stop me anytime in between. Okay. So in week 5 we started our discussion regarding uncertainties. In first 4 weeks. Okay, 1 second. I In first 4 weeks we were only discussing about the situations where all the conditions were known to us. But in this part of our lectures we started our discussion when like there is uncertainty in the economic environment. For example, like there are three possible states with different probabilities pi 1, pi 2, and pi 3, and outcomes p1, p2, p3. Then from our statistics knowledge we know that how these are the like the we can calculate the expected value, variance, and standard deviation, and these are the straightforward like the outcomes of our like the statistics class. So expected value will be the probability weighted average. Variance is like it is a measure of variation in the outcome due to like if there is uncertainty, and we will encounter these values again and again in our course. Okay. And then there was a short discussion regarding fair weight. So a fair weight is the one which costs its expected value. For example, if there is a bet which pays 200 with 25% probability and 500 with 75% probability, then what would be its expected value? So we can calculate its what will what would be its fair price. Then we can calculate its expected value, and that will be equal to its expected. That would be equal to its fair price. Okay. So if we calculate the expected value, that would be 0.25 times 200 plus 0.75 times 500, and that is equal to 425. So this is the fair price of this bet. Okay. Now, like from where this uncertainty comes, that is the question. That comes like when some things which is bound to happen, but that does not happen. For example, if you lend some amount to one of your friend, and he then later on he denies to pay you. So that means he is defaulted. So there may be two types of default. One is full default. In that case, like your friend will pay nothing, so he will pay zero amount. So you lend him, let's suppose 5,000 rupees, and later on, when the time of payment comes, he says, I have don't money and I will not give you any money. So he is doing full default. But sometimes situation comes when he says like I have only 2,500 rupees, so he pays some of the amount. So in that case, we call that partial default. Okay. So whenever there is a situation that there is a chance of default, then usually usually the person who is lending, in this case if you are lending, then you are bound to charge him high, because you are taking that risk that in future you are not going to get back your money. Okay. So let's understand this through an example. So I have given some like the definitions of time premium and default premium. And as we discussed, like time premium and term premium are like used interchangeably. So for example, a government bond pays 5% in 1 year, and so you have two possibilities. You can invest in government bonds, or you have another option, that is you lend your 5,000 rupees to your friend who pays back the full amount with 90% probability and pays nothing with 10% probability. Then question asks like, what is the interest rate that you should charge to your friend? Here what we are doing, like here we are assuming you are risk neutral. Okay. So now what would happen, like you should have same expected outcome in both the case, like when if you are investing in government bonds or if you are lending to your friend, in both case you should have same outcome, because you we are assuming that you are risk neutral. So if we use that concept, then we can calculate like how much high you should charge, just because there is a chance of default when you are lending to your friend. So when you are investing in government bonds, then this is your expected outcome in 1 year. If you are lending to your friend, then yes, you are asking X amount, which I want to like to find out how much should I like the what should be the promised amount. With 90% chance he will pay this amount, and with 10% chance he will pay zero. So using this, solving this equation, we get like the promised amount should be like, if you are giving your friend 5,000 rupees, then you should ask him that he should pay you 5,833 rupees.
Sir,
And
sir,
we can get, yes,
can you write what is X and what is O like that, sir, in detail? And
X is the
future reference
promised,
will be difficult, sir.
this is the promised amount. Like,
Oh, okay, sir.
as I said, like he pays the full amount or the full promised amount. Okay. So the promised amount is this, then if we can calculate the interest which is charged, like if he is paying this much amount, then your interest that is charged is 16.67%. Now, this 16.67% can be bifurcated into two parts. One is like that which the safe assets, which is the government bonds that is paying, like 5% you are getting by investing in government bonds. But you are charging him 16.67. So we can bifurcate in two parts. One is the fixed, like the safe return or the risk-free return which you are getting. Another this like the surcharge or the extra interest which you are charging him. So the safe one, that is the time premium or the term premium, that is you are getting because you are delaying your payment. And second part is the default premium or the credit premium, which is you are charging because there is a chance of default. Okay. Okay. Now we get back to our discussion of capital budgeting, which we did in week 3, and here we are introducing uncertainty in capital budgeting rules. So in like in the case of uncertainties, the like different situations are represented in the form of payoff table. So how do we read these payoff tables? So it says like there are two possible states. There may be multiple, like three, four, five, multiple states may be possible. We are taking an example of two possible states. One is the bad state and one another is good state. Bad state happens with 1 by 4 or the 25% probability. Good state happens with 75% probability. If bad state happens, then the value or the final payoff that is 60. It may be 60 lakh, 60,000, 60 crore, anything. Like I am just giving you simplest numbers. And if the good state happens, then the final value will be 100. Okay. And the expected rate of return is 20%. Given this situation, we can calculate the expected value. Like there are two possible states, so we can calculate the expected value that turns out to be 90. And so that is like in 1 year. And this is the expected rate of return. So I have expected value, I have expected rate of return. I can calculate the present value that turns out to be 75. I am like discounting the expected value by the expected rate of return. I am getting the present value, that is 75. Okay. Now 75, the present value should like, if the markets are like there is no information asymmetry, then any project's present value should be equal to its price. So if 75 is the price of this project, then this project can be financed with like the can be financed by two major sources of financing, which are known as debt and equity. Debt means like, debt is a type of loan. Like you take a loan from bank or any other financial institution, that we call as debt. Another is equity, that you are giving ownership rights to the individual who is giving you the money. So equity is like equivalent to the shares or the stocks which are there for the companies. Okay, this form of financing we see in our day-to-day life also. Like most of the companies like to go for these financing tools only. So, like for example, like 75 was the total cost. So out of that, 70 is financed with debt, and 5 units is financed with equity. Okay. Now, now the question asks like, how much interest would the creditor of the debt should demand? So here the rule about debt and equity is like, the debt creditors are paid off first, and later on the equity, like the equity owners are paid off. So for example, if the like whatever amount is promised to the debt owner, that will be paid off first. Whatever outcome or the value comes from this project, and later on the equity owners will be paid off. Okay. Now, so the debt owners, debt, the debt value, debt present value is 70. So how much should the debt creditor charge you in this type of situation when there are two possible states, good and bad? Okay. And it is said like the expected rate of return is 20%. That means this is the safe rate of return which we are considering. So if this is the case, then if the debt creditor has invested in the safe assets or the government bonds, then he would have received 20% on that. But he decided to invest in the this project, and how much he should charge it. So here also like we will try to like, if bad state happens, then total value of the project is 60 and the debt amount is 70. So the whole of this value will go to the debt creditor. But if the good state happens, then the total value is 100, but out of that, some of will go to the debt creditor, and we want to find out that promised amount, how much the debt creditor should demand. Like if the good state happens, that this much amount should be given to me. Okay, if we solve this equation, then this promised amount turns out to be 92 units, and we can calculate the return from this. So if the good state happens, then he is getting 92, and he has like invested 70. So from that, the in the good state, return to the debt creditor is 31.4%. In the bad state, he is only getting 60 units, so he is making a loss, and the total return is negative 14.3%. Similarly, in the case of equity owner who has invested 5 units, so in bad state, total value or the total payoff is given to the debt creditor, so he is getting 0. In the good state, he gets like the remaining amount, that is 100 minus 92, that is 8 units. So in both case, we can calculate the return also. So in the bad state, return is negative 100%, and in the good state, return is 60%. That is like 8 minus 5 by 5. You can calculate the return, and that is 60%. And we can check like the big age we are considering the risk neutral word. So the expected return for both debt and equity will be equal to the expected return which we considered earlier, that is 20%. So this was the discussion which we had in week 5. So here we introduced the uncertainty in the economic environment and how it impacted our valuations or the capital budgeting tools. If you have any doubts regarding this, please let me know regarding any topics in the. And I also noticed like questions regarding one of the question in GF5, I think question number 6. So that is a slightly tricky question where like the two states are given, but the trick is like in usually in the questions the payoff amount is like the different in different states, but in that question the cost is different in the given two situation. I think the like the preparing or the building a road construction question was there. So the cost was different. So in that question, like the if cost is different, then you have to calculate the returns in those good and bad state, and from that you have to calculate the expected rate of return. Because cost is changing, then this denominator is changing in both the cases. So that was the trick part in that question. Okay. GA5, question number 6, I think. Okay. Now there was a small discussion regarding the balance sheets. So balance sheet means like the how firms or the banks record their different transactions. So transactions will be part of either liabilities or assets. Assets means the which are owned by the firm or the company, and liabilities which the company owe to others. So in the case of banks, so the deposits are the liabilities for the banks. So because they have to get like the give back that deposited amount to the like the who are the depositors or the public, and the assets for the banks would be the loans which they have dispersed to the firms or the public. And capital is the amount like which the owners have invested to build the firm or the bank. Two key like the parameters we discussed. One is the leverage ratio and capital ratio. These are the like the they were opposite of each other. So leverage ratio is nothing but the ratio of the assets to the capital. And if the leverage ratio is higher, then it leads to higher expected payoff, but at the same time, it leads to higher chances of bankruptcy. So there is a trade-off, like the what is the optimal leverage ratio for a particular bank or a firm, and each bank tries to find its optimal leverage ratio. And a bank is called insolvent if the value of bank's assets is below its value of liabilities. That means bank has less number of amount of or the assets which it owns in comparison to the value of the things which it owes to others or the public. Okay. Now in week 6, we started our discussion regarding choice theory. Choice theory means like how an individual makes decision or the make choices. Okay. So we have discussed this part also in our previous live sessions also. So for example, there is an individual and we are taking first we will discuss the situation where there is like the certainty in the environment. That means like the things are known to you, the income prices etc are known to you. For example, there is an individual who has income of amount m, and he wants to consume two types of goods, x1 and x2. These two are goods, this is income, and p1 and p2 are prices. So if he wants to consume two types of goods, X1 and X2, P1 and P2 are their prices and M is his income, then this inequality represents his budget set. That means like the total consumption value P1 X1 plus P2 X2 should be less than his income. This sounds reasonable because he cannot consume more than his income. Okay. And if we replace this inequality by equality, we call that budget line. That means he is consuming all of his income. Okay. Now the slope of this budget line is minus P1 by P2. Okay. Now this is the like this budget set represents the all the possible combinations or combinations of goods X1 and X2 that is available to this particular individual. Now we should know like his choice will depend on like what he likes or what he prefers, and these preferences are represented by the utility functions or the indifference curves in this x1 x2 plane. So these indifference curves are the curves which represent the in the combinations of x1 and x2 which have the same utility. Okay, and these are these downward sloping curves, and if we move away from the origin, that means there is more utility, higher utility. So moving in this arrow direction means like these are the preferred ones. And if we look at graphically, so these are the feasible shapes. These are the feasible shapes, and these are the indifference curves. And I want to find out the farthest away curve. Then that would be the one which is just tangent to the this budget line, the indifference curve that is tangent to this budget line. So this green dot is the optimal consumption point for this individual. Okay, so the choice would be the choose the bundle where the indifference curve is tangent to the budget line, and mathematically that would be equal to like the slope of indifference curve is the marginal rate of substitution, that should be equal to slope of this budget line, that is minus p1 by p2. And we have solved some questions in the lectures as well as in the live sessions of this. Now when there is uncertainty, then then we do not have simple budget constraint or the preferences. We have state contingent budget constraint and state contingent preferences. That means in different states there will be like the different consumptions. For example, there are two possible states, good state and bad state. Then in good state, you are the individual consumes CG amount. In bad state, individual consumes CB amount. And the probabilities for these two states to happen are the pi G and pi B. So using this, we can derive the state contingent budget constraint. And also regarding the utility, if the utility function is given by this, then the expected utility function is like the probability weighted utility for both states. That means if this is the utility function, then expected utility will be this one, like 0.9 times the square root of Cg, that is the utility function, plus 10% times the square root of Cv. So in the case of uncertainties, we have to use expected utility function and state contingent budget constraint. So for example, there is a individual, she buys like there are two possible states, good and bad. So he want to insure herself in the case of bad state. Then how she can insure herself by like buying an insurance. So if she buys an insurance which costs her like the 10% of the insured amount, it means if he wants an insurance for X amount, then she have to pay 0.1 times X amount in the form of premium. Okay. And how this insurance works, like if bad state happens, then she will get the insured amount. If the good state happens, then she will get nothing. She will only get the good state's outcome. Okay. Now we can derive the state contingent budget constraint from this. So in the good state, this is the income in the good state. This is the income in the bad state. We can write conditions for both the states, like this is the good state condition This is bad state condition. So in the good state, consumption will be equal to income minus the premium. In the bad state, consumption will be equal to income in the bad state plus the coverage she receives from this insurance minus the premiums which she pays for the insurance. And by these two equations, we can eliminate this insurance amount X by multiplying the first equation by 0.9 and second equation by 0.1, and by summing up we can get this equation which we call the state contingent budget constraint. We have this budget constraint, we have utility, we can apply again this like the earlier conditions, like what in which what we do, like we maximize utility subject to budget constraint. That is our choice theory. Like we our like the our objective is to maximize the utility subject to budget constraint. We can solve this by like we know the method of Lagrangian which we use to solve this this choice theory question. Okay, so this was a discussion regarding the goods case, but we were discussing regarding in the finance. Like in finance, we discuss about investments. In investments, like a rational investor would prefer higher mean but less variation. That means mean is a good thing for an investor, but variation or the risk, which we call the risk also, risk is a bad thing for an investor. Okay, so utility is increasing in the case of mu, that is return, and variation, that is sigma. So it is increasing in the case of return and decreasing in the case of sigma, that is the variation or the risk. So if you want to draw these indifference curves in this return and risk coordinates, then this will be this upward sloping curves will be the shape of the indifference curves, and in this direction is the one which is the preferred for a particular investor. And how do we know that these indifference curves are positively sloped? We can look at like this is the slope of indifference curves, that is like this above one, like del u by del sigma, that is negative, del u by del mu is positive, and negative of total would be, so this value is greater than 0. That's why we know that these indifference curves will be upward sloping. Now we got the preferences or the indifference curves. Now what do we need? We need the budget constraint. Okay. Let's suppose there are two types of assets available to the individual. One is the risky and another is the risk-free. Risk-free asset is this RF amount of return, and this is risk-free. That means this is like the sure short return for investing in this type of asset, and there is no variation. And for the risky asset, RM is the expected return and sigma m is the variation in the return. So what would be the if the individual invests X amount in the risky asset and remaining amount 1 minus X in the risk-free asset, then the expected return is, this is expected return, that would be X times RM plus 1 minus X times RF. And variation only comes from the risky part, so that would be equal to X square times sigma m square. From this, like by taking the square root, we can get X equal to sigma X by sigma m. By replacing this X value in this equation, we can get an equation in the form of Rx and sigma X, which we wanted, like Rx and sigma explained, we wanted a relation between R and sigma, which we get in the form of this, that is like Rf plus Rm minus Rf by sigma m times sigma X. So this is the slope, and also by our discussion of weak 8, we know that this ratio is known as the Stark ratio. like which is a measure of reward to the variation. So how much extra you are getting in order to taking this sigma m amount of variability or the risk. Okay. So we have got the budget constraint, we have the utility or the indifference curves. And from our choice theory discussion, we know that the optimal point will be the one where this indifference curves are just tangent to the budget constraints. So this green dot represents the optimal investment combination of investment combination in the form of mu and sigma. Mu means return and sigma means risk or the standard deviation. And this ratio, this SARF ratio is a very important ratio. From this we can we can if we have two possible assets like asset 1 and asset 2 with R1 and sigma 1 return and standard deviation, R2 and sigma 2 return and standard deviation, then we can compare these two values like the SARP ratio of these two assets, and we can make our decision like we should always choose the asset which has higher SARP ratio, because SARP ratio is a measure of reward to the volatility or the reward to the variation. Okay. Now we had a short discussion regarding like different measures of risk, and one of that is the beta, and we will be having a deeper look at these like beta and capital asset pricing models later in our course. But we had a short discussion like, and beta is a measure of riskiness of a particular asset. And how do we measure that? We measure that by using this formula, that is the covariance of the asset with the market divided by the variance of the market return. Okay. And this beta is used later in like the in order to find out the benchmark return for a particular asset. So if we know the beta of a particular asset, if we know the beta of a asset I, then the benchmark return for this asset would be equal to risk-free return plus the beta times RM minus RF. RM is the market return and RF is the risk-free return. So we get this benchmark return. So we compare the actual return of this asset I with this benchmark. So if actual return is higher, then yes, like this is a good investment choice. If actual return is less than benchmark return, then this investment like is not worth investing. We will be having a deeper discussion on these two, like this beta and CAPM later part of our course, like in I think in week
What is
11. Yes,
what is RI here?
RI
Risk
is
of
the
that.
return on asset I, and beta is the riskiness which we measured by this formula. That is the riskiness of this asset I. Okay. Now here we discussed about like the preferences or the utility functions. One important type of utility function which we encounter is the mean variance preferences. That means the utility only depends on the mean and the variance.
One question, sir. Before.
Yes.
Is the slide above?
Yes.
So if my asset has a high correlation to the market return, then my return on the asset will go up, right? How high covariance with the market?
Yes.
Okay.
Yes. So mean variance preferences means my like the utility mainly depend on the expected return and the variation or the variance of the return. Okay. And here a parameter which A comes into the picture, which we call the risk aversion parameter. If this A is higher, that means the individual is more risk averse. If it is lower, then that means individual is less risk averse. He likes risk. If it
But
is
this
negative.
utility function is a standard function for this mean variance preferences.
Yeah, this is the standard format for the mean variance preferences.
Okay.
There are different types of utility functions there in the market, because in the reality, my preferences not only depend on mu and sigma, but it depends on a lot of other things also. So if we dig deeper in the finance courses, then there are like the cost, I think CARA, I think CARA or CRRA or CES. Yeah, these are the different types of utility functions. CARA means constant average risk aversion utility function. CRRA means constant relative risk aversion utility function. And like there are different types of utility functions, like these are more complicated functions which are given by the economists to like the represent the reality in better terms.
So this is the
Okay,
base
in
function.
these functions, like a lot of parameters comes into the picture
Mm,
in these like the like the complicated utility functions.
right.
But for our discussion or for our understanding purpose, we have taken this. This is one of the simplest possible utility functions which is there in the theory, which we follow, like to understand the basics of the investments or the financing theories.
Okay.
So if this like the how this risk aversion parameter like the impacts the indifference curves, if like the this if the risk aversion parameter is higher, then this indifference curves becomes steeper. That means like if for example if this risk aversion parameter value is 10 in comparison to risk aversion parameter is equal to 4, then the value 10 curves will be steeper in comparison to the indifference curve, that is value of risk aversion parameter equal to 4. Okay, now we are moving towards the discussion of the portfolio theory. So portfolio means like I portfolio means a combination, like the combination of multiple assets. For example, if you have a portfolio of n assets and I am representing an individual asset I, and that has expected return of Ri, standard deviation of sigma I, and I am investing Wi amount of my wealth in this asset. So Wi amount is the weight given to this asset. So if these are the conditions, then the for this overall portfolio of n assets, the portfolio expected return would be equal to this formula, that is some weighted sum of expected return of each of the asset. Portfolio variance is given by this formula, that is like wi wj times sigma ij. So if I equal to j, then this sigma ij becomes sigma ii, that is nothing but the variance of particular asset I, and sigma ij is the covariance of I and j, asset I and asset j. And we had a small discussion regarding like how diversifications, what are the benefits of diversification, how correlation impacts the benefits of diversifications. Okay, so let me give you an example. For example, there are like the 10 uncorrelated similar assets are there with expected return mu and sigma square as the variance. Then what is the mean variance, like the portfolio of this? You combine, you make a portfolio of these 10 assets, then what is the variance of this portfolio? So these 10 assets are same or the similar. So by intuition, and if you solve by the, by using the Markowitz model, okay. So from that also, by intuition or the by solving also, we you get like the you give the same weight to all the assets, so equal weights. there are 10 assets, so each asset gets 1 by 10 is the weights, and from that you can calculate the portfolio return, that is like sum of WI that is again equal to mu, and if you calculate the sigma square, that turns out to be sigma square by n, and if you standard deviation, that becomes, that is sigma by root n. That means you have the variation has reduced as you have included more assets into your portfolio, and these are uncorrelated. And in the lectures we did an example also where we introduced some correlation between the assets, and from that we found out that this, like the reduction in variability is not as much as in the case of uncorrelated assets. Okay, so that means if there is less correlation between the assets, that leads to higher benefits in the form of diversification. Okay, now the question asks how the example to use these formulas. So this is given like for the asset one, the expected return is 12%, standard deviation is 20%. For asset two, 15% is the expected return and 18% is the standard deviation, and the covariance is given as 0.01. Okay, and the weights are given as 25% and 75%. Then it asks you to find out like the portfolio return and portfolio variance. We have applied this formula, and from that we have calculated the portfolio expected return and portfolio variance. Please go through these calculations. Like I have done it by myself. I recommend you to do by yourself and find out whether these calculations are correct, or if there is any changes, please let me know. Okay, these are the basics, like how do we calculate the portfolio expected return and variance. And from there, like
Sir,
my point, yes,
when you are calculating the sigma square, the
yes,
sigma ij in sigma 1, 2, that figure is not here, missing.
this is here, like I sigma in the two asset case, sigma square will be W1 square sigma 1 square plus correct,
And then
or this.
sigma 1, 2.
So this term I have written it earlier. So this is the W1 times sigma 1 square plus 2 times W1 W2 sigma 1 2, I think.
Instead of sigma 1, 2, you have written something else.
Yeah, I think I have done something else. I have done 0.18, and here I have tried to, I have to multiply it. Yes, I used that formula, like instead of sigma 1, I use rho sigma 1
If it
sigma
is
2.
low, then yeah.
Yes. I did a mistake here, so that's why I asked you to like go through these calculations, because I did it like the some time before only, so there may be some calculation mistakes there also.
Okay.
So when I will be sharing these notes, I will correct this calculation here at least.
Okay.
Okay, so now from we understood how do we calculate the portfolio expected return and variance. And so if we are given two assets, this asset 1 and asset 2, with mu1 and sigma 1 and mu2 and sigma 2, we can represent them in the mu and sigma plane, and from that we can get four different types of variables. First is the feasible set. Feasible sets means all the possible combinations of mu and sigma which you can get by the combining these two assets, this asset 1 and asset 2. So this feasible set is represented by this yellow shaded area. This feasible set means all these possible combinations are available to you. Okay. Now, any rational investor would always choose minimum possible variation for any given for any given for any given value of return. For example, if I am taking this value of return, so for this value of return, any rational investor would choose this amount in place of all the possible points which are feasible to him. So this leftmost boundary is the one which any rational investor would be looking at, because he would be interested in. He would never go for any point beyond this leftmost boundary. And so this leftmost boundary is called the minimum variance set. Okay, the leftmost boundary of the feasible set is called the minimum variance set. Okay, now in this leftmost boundary there is the leftmost point also, that is like with the point which has the minimum possible sigma or the minimum possible variation, that is represented by this purple point, and we call that the GMV or the global minimum variance portfolio. Global minimum variance portfolio. Okay, now if you draw any vertical line for any point, so for example, if I draw a vertical line at this point, okay, so at any, so this sigma bar point, at the sigma bar point, there are two possible portfolios, this in the upper part or the lower part of the minimum variance set. So any rational investor would always, so at these 2 points, like the sigma is same, but this mu is different. And for any rational investor would always prefer the higher value of mu. So the part which is above this GMV of the minimum variance set, that is the part at which any rational investor would be looking at. So this part. So I am highlighting it by this one. So this part of the minimum variance set, that is the part in which any rational investor would be looking at, and we call this part is the efficient frontier. Okay. So efficient frontier is the combination of mu and sigma, or the portfolios which comes with the mu and sigma, which is part of the minimum variance set and lies above the GMV or the global minimum variance portfolio. Okay. Now, once we got this graphical representation, and how do we come to this? We come to this by this Markowitz model. Markowitz model is nothing but a minimization problem, which is like we are minimizing the portfolio variance subject to given conditions on the returns. So there will be two conditions. One is the expected return should be given if we are given with some portfolio return which you want to achieve. So if that is given to you, then this condition will be there, and another condition will be that sum of the weights should be equal to 1. So you want to solve this minimization problem, you can use the Lagrangian method and solve this, and you can come up to your value of the different weights.
So why are we taking half here?
This is like the, sorry. So this is given in the Markowitz model. This is the parameter. Okay. So this half does not like does not impact your final solution. It is given like in the Markowitz model. This is given like this. Okay. This half value does not depend your final answer.
Yes, sir.
Okay, and if you want to find this global minimum variance portfolio, then this condition will vanish. This condition will vanish, and so you will only remain with this sum of weights equal to 1. If you remove this condition, then you reach to this global minimum variance portfolio. For example, if we take an example, so there are two assets with given these conditions, R1 sigma 1 and R2 sigma 2, and rho 1 2 is given to you. Okay, then it asks you like find a portfolio with R bar equal to 18%. So you can solve it by using this like the condition also, but in the case of two assets, it is very much simpler because the if there are only two assets, then if you invest W amount in asset one, then one minus amount goes to asset two. Okay, and you can use simply the portfolio expected return formula. So the W times R1 bar plus W2 1 minus W times R2 bar, that should be equal to this like the required return. So by this also, like there is one equation, one unknown, you can solve this and you can get the value of weight. But if the situation comes for the in the three asset case, then it becomes a bit complicated and you have to solve it using this Markowitz model only. Okay, now it asks like you got the weights for like the for the asset one you got the 60%, for asset two, so W this is equal to W1, let's suppose, and W2 equal to will be 40%. So you can calculate the, so this is the expected portfolio return. So it asks you to calculate the variance of this portfolio. We apply the formula W1 square times sigma 1 square plus 2 times W1 W2 sigma 1 sigma 2 rho 1 2 sigma 1 sigma 2 W2 square sigma 2 square. Okay, and if we solve it, we get this value for the variance, and we can calculate the standard deviation by taking the square root of this variance formula. Okay, now like the if, as I said, if you want to find the minimum variance portfolio or the overall minimum variance portfolio, then in that case, this the first condition, first subject to condition vanishes, and your like the problem becomes like in the two asset case, you want to minimize the portfolio variance subject to weights, that portfolio variance equal to this subject to W1 plus W2 equal to 1. You set up the Lagrangian, okay, and by deriving the first order conditions, and you can solve and you get the values for like the W1 and W2. You can put the values which are given there and you can get the final values. I would recommend you to solve these three equations and find out the values for W1 and W2 by yourself. If you do it yourself, then you get a better gist of like the how do we arrive to the weights of different weights of this minimum variance portfolio. So this was the case when there were two risky assets, okay, like the asset 1 and asset 2 both were risky. In that case, how do we solve? We solve using Markowitz model, like by minimizing the variance subject to the condition on the weights and the return. Now, if the situation comes when there is one asset is the risky and another is the risk free. Okay, if you look closely, this is the same case when like when we are trying to derive the budget constraint, or when we are trying to derive the budget constraint in the cost in the case of like the in the case of this investing choice, like the choice under for the investments. So how do we compare that? So for example, there are two assets, risk-free asset which has RF amount of return and sigma f for the risk-free asset is 0, and the risky asset has RP and sigma p as the variables. You invest W amount in risky asset, 1 minus W amount goes to risk-free asset. So the expected return equal to this one, and the variation only comes from the risky asset, that is W square times sigma p square. And if you replace this value of W that is sigma c divided by sigma p in this equation, then you get to like this equation becomes same as the budget constraint, which has like the slope of that budget constraint was the Sharpe ratio. So you get this equation. So we can represent this line and we call this line, or this is equivalent to the budget constraint which we got. Okay, so budget constraint has the slope of budget constraint is Sharpe ratio, and these are the parameters. The intercept, the y intercept is RF, and slope is S, that is the Sharpe ratio. Okay, now we got earlier in the risky asset case, we got this efficient frontier. Now in the risky asset case, we got this capital allocation line, and now we combine both of them to find the optimal risky portfolio. Okay, and which one will be the optimal risky portfolio? Will it be the one which has the minimum variance, or it will be something else? As we earlier discussed also, the Sharpe ratio is the measure of reward to variability. Okay, so for to find the optimal one, I want to get the portfolio which has highest reward to variability. That means you should have the highest Sharpe ratio. So the optimal risky portfolio will be the one which has the maximum Sharpe ratio. And which one will be the that? So that one will be the one which like the at which this capital allocation line is just tangent to this efficient frontier. Okay, and we call, so this will be the optimal risky portfolio, this green dot, and we call this the optimal risky portfolio or the tendency portfolio as well, because at this point, at this portfolio, your capital allocation line is just tangent to the efficient frontier. And throughout this discussion, we have not discussed anything about the preferences. So individual preferences does not impact this optimal risky portfolio. Okay, that does not come into the picture because this individual preferences does not impact the capital allocation line, and it does not impact this efficient frontier as well. So this is same for all the individuals. This optimal risky portfolio is same for all the individuals. And this is the basic concept behind the working of mutual fund industry, because they invest in, they try to find out this optimal risky portfolio, and they know this concept that, like this will be the same. So they invest on the behalf of all the mutual fund investors, and they use this concept, this optimal, like this optimal risky portfolio will be the same for all. Okay, now once we got this optimal risky portfolio, then the situation now, like, so all the individuals have the same optimal risky portfolio, but they have different tests for risk, like their risk aversion parameter will be the different. So they,
One question, sir. Sorry.
yes.
So this the mutual fund company. So there's a particular fund which is same for all investors, irrespective of investor preference. But if I allocate capital to different mutual fund types, then I can be able to match to the consumer preference. So if I have 5 mutual funds with different portfolios in there, so different weights of capital. So if I one like I put 20,000 in one or 30,000 in one, and then try and match with the consumer preference. Can that work?
Yes, that analysis is done by many economists. But if you see, like in real world, different mutual funds give you different returns and different, because they, every company or every mutual fund has different type of, like the analyst or different economist there, and they have different ideas or the different intuitions regarding the individual preferences, not individual preferences, like regarding different, like the in the market there are a lot of assets are available, and they are not able to consider all the possible assets into their portfolio, correct? So
Right.
so each mutual fund will have like the, they will like the, if you
No,
look
my
at,
question is separate, sir. What I'm saying
yes,
is, so I take a set of mutual funds, different kind of mutual funds.
okay,
And am I able to create an efficient frontier out of them? Taking
yes,
each mutual fund as a risky asset separately,
yes, you will be able to like the find a
efficient way.
this one, yes, efficient frontier. So
So
for
there I
that,
can
I
try and match the consumer, no?
try and match what,
The individual consumer. So suppose I have a client who wants a particular, has a particular appetite for risk. So
okay,
picking up different mutual funds and knowing their Sharpe ratios and knowing their sigma and knowing their return, so I
hmm,
can make a combination, create an efficient frontier and match it to that particular individual's risk preference.
correct, yes,
Okay.
true.
Thanks.
So you can do that, but like we are doing a simplified analysis of this investing theory. And here, what I mean, like if I have full information regarding the market, so if you create that like the efficient frontier by using multiple mutual funds, for example, you take 5 mutual funds and you form this efficient frontier, then my point is like for any investor, your optimal combination of these mutual funds would be the same. That would not depend on their
Right.
preferences.
Right. Sir. Right.
Yes. Yes. Now, once you have found this optimal risky portfolio, the optimal combination of risky assets, okay, that is represented by this green dot. Now, and you have this capital allocation line that is just tangent to this efficient frontier. Okay, now here comes the differences into the picture. So this capital allocation line is, as I said, this is same as the budget constraint. So for an investor, the optimal capital allocation point would be the one where his indifference curve is just tangent to this capital allocation line. So that is represented by this yellow star. So this yellow star is the optimal capital allocation point for an individual investor. Okay. So in our case of like the, in order to find our optimal investment allocation, there are 3 steps. First, we find this frontier by like the by Markowitz model. We find the minimum variance set, and from that, like we find the this efficient frontier. Then we find the optimal risky portfolio by which is the one which has the maximum Sharpe ratio. And once we got this optimal risky portfolio, then by combining this preferences and this capital allocation line, we can find this optimal capital allocation. And we will have a small example of this thing and how do we solve for that. Okay. Now there was a small discussion regarding the short selling. Short selling means like that you sell an asset which you do not own. So how this process works? You what you do, like you go to the your broker and you borrow the asset from that broker. You sell that borrowed asset to the buyer at price, like the first price is P naught. You wait for the price fall, that is like the later, let's suppose price fall to P1. You go to the market, from the market you buy the asset at P1 price and you return this asset to the your broker, and you get gain the profit from the price difference. For example, you sold 100 assets of an company which is selling at 500, and later the price fell to 450. Then what is your profit? So by sorting you gain 50,000 rupees, price fell to 450, then You purchased them back at 45,000, so the total difference is 5,000. So your total return is calculated on the initial transaction amount, that is 50,000 rupees. Okay. Okay. Now we will take a example. So for example, if we know this risky assets mu and sigma, then how, and if we know the preferences, then how can we calculate this, like the amount which an individual should invest in the risky asset and the risk free asset. So that is like, for example, the risk free return is 7%, and this optimal risky portfolio has return of 15% and standard deviation of 22%, and utility is given by this mean variance preferences in the form of mu minus 2 sigma square. Then find the optimal weight for the risky asset. This is the question. So in this question, like what would be your, like the problem, that would be like maximize utility, and here we are assuming like W weight is given to your risky asset. So I have directly put in the value. So the mu will be RF plus W times RP minus RF, that is the expected return, and variation only comes from the risky asset, that would be equal to W square sigma P square, and I am maximize this subject to W, so I just differentiate it with respect to W, and from that I can get the value of the W. So the W comes out to be this. If I put in these values, then the weight is 0.41. That means 41% of your wealth should be invested in the risky asset, and 59% should go to the risk-free asset. If these are the, if this is the condition given, this is the preference, this is the utility function which is given for the individual. And if you got these numbers, then you can calculate the expected return, sigma, as well as the Sharpe ratio. And I would recommend you to do these calculations on your own, and please let me know if there is any there is any mistakes made by me. Okay. Now let's take the lengthy example or the full example. So for example, if question say like if there is a government bond, or the return on the government bond, that is the risk-free return, that is given to be 2%. There is a asset which is equivalent to debt, that is having return as 6% and various standard deviation as 5%. There is an equity asset which has return of 12% and standard deviation of 20%, and the correlation between debt and equity is 0.25. Then question asks like find the optimal risky portfolio and then find the optimal weights for these three assets. So in order to find the optimal risky portfolio, we need to, so the optimal risky portfolio will be consisting of the risky assets which are debt and equity. These are the risky assets. This is risk-free asset. So in order to find the optimal risky portfolio, you need to maximize the Sharpe ratio. Okay. And to find the Sharpe ratio, we need the expected return of the portfolio and the variance of the portfolio. We know the formulas for the expected return and portfolio variance. We apply those formula, and in the first place, we are just looking at the risky assets, so debt and equity. So if you are investing WD amount in the debt, so the remaining amount you will be investing in the equity, that will be 1 minus WD. So if you use these values, you can calculate the expected return of the portfolio, and you can calculate the portfolio variance by this formula. You got the sigma p square, you got the RP, and you can calculate the Sharpe ratio, that is RP minus RF by sigma p. So this is the Sharpe ratio. Okay. So in order to find the optimal risky portfolio, you need to like the maximize the Sharpe ratio subject to WD. So for that, like the first order condition will be like the derivative of Sharpe ratio with respect to WD equal to 0. Okay. And I have done these calculations, and we have done this in one of the questions of the graded assignments also, and in the live, like in one of the lectures also. Okay, so it is a very lengthy process, like the mathematically solving for the optimal risk portfolio is a very lengthy process. So I have given this example just for the brevity of like the understanding, like how do we find the optimal risky portfolio. But in the exams, we refrain from asking these like to finding this optimal risky portfolio things, because it is very hard to solve these lengthy questions in the exams, as exams are time constrained. So this question is just for your understanding, and I would recommend you to like solve one of this type on your own. Okay. And once you solve for the optimal risky portfolio, which I have done. So for the optimal risky portfolio, I have found the RP and sigma square P. Now this problem becomes same as this problem. Okay. So if these conditions are given, then you can solve for the optimal weights for the risky asset and the risk-free asset, and the weights which you get for the risky asset. So for example, here you got 41% for the risky asset. So out of this 41%, some will go to debt and some will go to equity, and that will be equal to this one. Like weights are 68% for the debt and 32% for the equity. 68% in debt and 32% in equity. This is how we find the optimal combinations of different risky and risk-free assets. Okay, this was the content which we covered in like the last 4 weeks, and which will be part of your upcoming quiz. If you have any other questions, any other conceptual doubts, please let me know, like we can discuss them now. Okay, then. So I will be sharing these notes like in the G space only today only. And if you have any doubts, please post them in the Google space, because that is more accessible to me. And if you have any other doubts, please let me know. And I wish you all a very happy Holi and all the best for your upcoming exams. Okay.
Thank you, sir.
Thank you so much for joining. We will meet next week on Saturday.
Thank you, sir.